The CEO slams his laptop shut after another investor meeting gone wrong. His startup's burning cash twice as fast as projected, but he can't pinpoint why. Most founders treat funding like a roulette wheel, throw money at the table and hope for the best. They don't realize capital allocation works more like chess. Every dollar deployed needs to check 3 boxes: runway extension, growth leverage, and optionality preservation. Get one wrong and the whole strategy collapses. Venture capital firms spot these mistakes immediately. They see founders who raised $5 million but allocated $3 million to office renovations and hiring sprees. The math never works. Smart money looks for capital surgeons, founders who can dissect a balance sheet and know exactly which dollar funds which growth lever. Here's the brutal truth: startups don't fail because they run out of money. They fail because they misallocated it first. The difference between scaling and stalling often comes down to one founder who treated funding like an engineering problem, not a lottery ticket. The sock puppet dog from Pets.com grinned on Super Bowl 34 in January 2000. A 20-second commercial cost the company $1.2 million, plus the price of a giant fuzzy costume. The dot-com era made that math seem normal. Venture capital firms poured $300 million into a business selling pet food bags so heavy the shipping costs alone outpaced customer payments. The company's unit economics never added up, but cheap money papered over the losses until the warehouses emptied. Cheap money hides broken unit economics faster than any creative accounting trick. When a startup raises $50 million at a unicorn valuation, every dollar of revenue that costs $2 to acquire registers as progress. You celebrate the hockey stick growth chart while ignoring the cash incinerator beneath it. Pets.com lost $9 on every order. The board saw a customer acquisition machine. The numbers told a different story. Founders mistake capital hunger for market demand. WeWork leased 14 floors of a London skyscraper in 2017, filled it with free kombucha, and called the immediate occupancy proof of product market fit. But the tenants arrived because the rent was heavily subsidized by SoftBank's billions. The signal was fake. Take away the free beer and below market rates, and the vacancy rate tells you the truth. WeWork's community-adjusted EBITDA became the poster child for distorted incentives. Executives invented a metric that excluded all the core costs of running a real estate business. They treated office fit-out spend like fairy dust, not a future debt obligation. Every new location opened on a loss, yet the company valuation soared to $47 billion. Founders saw scaling as a milestone. It was actually a trap. A mega round locks in a growth treadmill that punishes any attempt to pause. You hire 2,000 people in 18 months because the investor presentation demands a certain headcount curve. You expand to 17 new cities before the first one turns profitable. Then the cheap money stops. Pets.com shuttered 9 months after the Super Bowl spot. WeWork's IPO collapsed, and the company lost $40 billion in valuation in a few weeks. The common ingredient wasn't a bad product. It was a team that confused free-flowing capital with a working business model. Scaling on cheap money doesn't reveal product market fit. It conceals the absence of it. The survivors learn a different lesson, but the real cost surfaces only after the investors move on. The inflated valuations become a permanent weight around the neck of any founder still trying to build something real. Consider a SaaS founder named Rachel. Her arranged buy just crossed $3 million and she takes a $10 million venture round at a $70 million valuation. The champagne goes flat before she even gets to the cork. Her lead investor didn't wire her money for lifestyle or for slow and steady refinement. That check came with an unspoken timeline. Her board needs a $100 million return from her company. That requires Rachel to get to $40 million ARR fast, which demands hiring 50 sales reps, which forces her to chase big enterprise logos, which means she needs those logos to sign in 6 months, not 6 years. The funding source itself rewrote her product roadmap before she opened the term sheet on her laptop. Venture debt pulls a different set of strings, quieter but no less binding. A company borrows $5 million with warrants attached and a 3-year repayment clock. The founders celebrate that they didn't dilute their cap table. They forget one thing: debt demands cash flow, and cash flow demands a predictable revenue engine. Suddenly the team stops experimenting with that risky new pricing model or the slow burn enterprise sales cycle. They optimize for the monthly payment schedule. The finance team pushes annual contracts paid up front. The product team kills the self-serve tier that converted slowly but consistently. The marketing team doubles down on whatever channel spits out cash this quarter. The debt didn't just fund the company. It fenced it in. Revenue-based financing looks like the perfect middle path until you trace the incentives. Providers like Pipe or Clearco advance capital against future revenue for a fixed fee. Simple on the surface, but the model only works when revenue moves in one direction, upward and to the right. A seasonal dip becomes existential. A product launch delay that pushes bookings back 90 days triggers clause in the contract. Founders with RBF lines start making hiring choices that protect the monthly multiple, not the long-term strategy. They say yes to customer requests that bloat the product because they need the revenue signal to stay green. The funding model selects for conformity to the current revenue engine, even when that engine needs replacing. Equity from strategic corporate investors introduces the strangest distortions of all. A logistics startup takes $8 million from a major shipping conglomerate. The founders think they bought a distribution partner and a customer. They actually bought a boss. The corporate VC wants integration on their proprietary systems, which locks the startup into a tech stack that repels every other potential logistics partner. The conglomerate's board loses patience with the moonshot strategy and demands the startup focus on problems that matter to their existing freight lines. 2 years later, the startup isn't a startup anymore. It's an outsourced R&D department for a tired incumbent. The equity came with an operating system, and that operating system wasn't the founders. Bootstrapped capital, meaning cash from customers, carries its own silent mandate. The freedom feels absolute at first. No board meetings, no repayment covenants, no corporate overlord asking for quarterly reports. But customer-funded growth is the least patient capital of all. Your existing customers paid for features they need next month. They don't fund speculative bets or adjacent markets. A bootstrapped company drifts towards serving power users so intensely that it loses the ability to attract new customer segments. The product calcifies around a single persona's wish list. The company survives, then stagnates. The cheap, clean capital exposed a hidden tax nobody planned for. The uncomfortable truth here is that every funding source is a strategy in disguise. You can't separate the capital from the constraints it bakes into your decisions. A founder who picks venture equity has chosen a binary outcome business whether they admit it or not. A founder who picks debt has chosen cash flow discipline over experimentation. A founder who picks customer revenue has chosen incrementalism over scale. The real question isn't which funding source is cheapest on a spreadsheet. It's which set of constraints matches the company you actually want to build. Most founders never ask that question until the answer gets expensive. Jeff Bezos walked into a quarterly business review in 2006 carrying a single sheet of paper. It wasn't a revenue printout. The page displayed the return on invested capital for every customer cohort Amazon had ever acquired, split by business unit. 2 lines on that small chart told a story the public markets wouldn't grasp for years. The metric that separates compounders from capital bonfires isn't blended ROIC. It's ROIC by cohort. You take every dollar you spent to acquire a group of customers. The marketing spend, the sales hires, the onboarding costs. Then you measure how much cash those customers generated after 12, 24, 36 months. A blended average hides the losers. Cohort-level data shows you where your capital actually earns its keep. Amazon's e-commerce business in those years was a feast of growth and a famine of returns. Each new customer cohort demanded more fulfillment centers, more inventory, more delivery trucks. The cohort ROIC for e-commerce stayed deeply negative for most of the first 2 years. Oz, by contrast, sold compute power from existing servers. Its customer cohorts turned cash flow positive within 6 months and compounded at rates above 50%. Executives looking only at blended ROIC saw a decent number. But the cohort-level split revealed the truth. One business was destroying capital, the other was minting it. That single sheet of paper rewrote Amazon's capital plan. Capital allocators who caught this signal early shifted their entire allocation strategy. They didn't cut e-commerce, it was the brand, but they stopped overfunding its marginal customer acquisition. They redirected every spare dollar into AWS infrastructure and sales. That single analytical shift turned Amazon from a low-margin retailer into the world's most valuable cloud company. The signal wasn't a growth story, it was a capital efficiency map that showed where each dollar multiplied and where it burned. Most growth stage companies never produce this number. They track blended CAC payback and blended LTV, CAC, and call it disciplined. But when you separate cohorts, the ugliest truths surface. The marketing campaign you were proud of shows a minus 30% ROI at month 18. The high-growth segment you just topped up with fresh capital has a cohort curve that bends down like a ski jump. Blended numbers let you lie to yourself. Cohort-level ROIC forces you to see exactly which bets are working before the cash runs out. If you ask a growth stage founder about their ROIC by cohort, they'll open a dashboard and discover the number doesn't exist. They'll see blended contribution margins, maybe unit economics by quarter. But the drill down that matters, the one that shows the compounding path of each dollar of acquisition spend, is missing. That absence isn't a data problem. It's a decision to avoid the signal. Once you see it, you have to act. And acting might mean starving the product line that carries your top line valuation. When the chart tilts downward at month 18 for your fastest growing segment, you face a decision no dashboard will make for you. That moment is where capital allocation becomes real. In a windowless conference room in Zurich, a private equity analyst clicked through a model that had taken 6 months to build. The spreadsheet didn't forecast revenue. It forecasted capital velocity. Every dollar that entered the portfolio company got tagged and tracked through 18 allocation gates. The analyst wasn't looking for winners. He was looking for leaks. The entire first half of this series circled one insight. Capital allocation isn't a fundraising event. It's a design problem. You don't win by raising more money. You win by engineering the paths money travels inside your business. The difference between a cash furnace and a compounding engine isn't the amount of capital you raise. It's the architecture you build around it. The smartest allocators don't bother with blended returns. They're chasing the signal that Bezos held up on a single sheet of paper. It's the return on every dollar, cohort by cohort, year after year. That's the measurement that turns capital into a design variable. It reveals which allocation gates are valves to widen and which are drains to cap. That's the static dimension of capital engineering. The blueprint. But blueprints don't move. The static allocation design is essential, yet it's only half the code. Companies that compound capital for decades don't just design a great scheme and leave it alone. They're reallocating constantly. They're exiting lines of business before the market sees the decline. They're timing their harvests with watchmaker precision. That's the dynamic dimension, and it's what Part 2 will decode. Without it, you're holding a perfect engine with no steering wheel. The biggest fortunes aren't made by designing the perfect allocation ones. They're made by knowing exactly when to break it. That's the algorithm Part 1 couldn't show you.